Good afternoon, everyone. I'm Brett Crowther. Good to be with you to cover short verticals on this Wednesday. This interesting Wednesday as the market has taken a bit of a dip, huh? And so we're going to have to look into that and see how to deal with that with our existing positions and also, what does that mean overall? We'll get into that here shortly. But I'm glad to have everyone with me. Great crowd out there. I love it. You know, you guys are a great crowd, and I just enjoy the camaraderie that I see week in, week out, and as I chat for the other classes and whatnot, it's just fun. So thanks for being here. But let's cover some disclosures as we get out, into our main topics here. So let's cover these important items. Do remember that options do carry a high level of risk and are not suitable for all investors. Information here is for general informational purposes only. It does not mean it's a recommendation or advice of any sort. Let's see, paper money is for educational purposes only, not a recommendation to buy or sell, and just hypothetical. Short options can be assigned at any time. That's an important one for our class, even if they're in, out, or at the money, right? Investing risk, you can lose principal. Past performance not guaranteed of future performance. And then there's your option Greeks. And we don't use stop losses in this class, generally speaking, but if there is one, just remember that they are not guaranteed to be filled at the set price. It turns into a market order and it can change from there. So what are we going to cover in this class today? As I kind of mentioned, the market has been dropping. So I want to look at the overall market real quick. I don't want to spend a ton of time on it, but I want to look at the overall market really quick, see what's going on with that, because I'm hearing just a lot of things out there from people as I've been looking at the other classes and reading social media. So I want to address what's going on in the market, and then what is that doing with volatility, and how is that impacting short verticals? That's an important question, right? What does it mean for us, our positions in this class, positions that we potentially are looking for? And then I want to look over those positions. Let's do a quick examination of them and make any adjustments we need to make. And then I got a couple stocks that we're going to look at for potential paper trades and see if they're still lining up. You never know. They were great an hour ago or 2 hours ago. Who knows if they're still there? And that's the challenge of teaching it live. And then lastly, I'll have some homework for you to walk away with it. Keep an eye on between now and next week. Now, do remember, I want to bring this up here. Follow me on X. It's at Brett Crowther CS is my handle. So, do follow me there. I do post quite a bit of stuff. Just even this earlier today, I was posting about Apple, which retracement level should it pull back to, and we're going to pull some of this stuff up here shortly. I was looking at a BMY, is that one? I think that's BMY. This is will it create a dead cat bounce, which is a gap down, and then a drop even lower after the gap, and then rally back up to the gap area, only to roll over again. And so, I post lots of different things. Also, market macroeconomics that's going on out there. A little bit difficult at this moment because the macroeconomics, are not coming out like we typically would have them, right? With the government shutdown and whatnot. But typically I'll post that kind of stuff. So keep an eye out for that. Follow me there. And it's just my way to keep in touch with you in between, each week, because sometimes a week is a long time to go without chatting. So let's look at the overall market here. Okay. I have the SPX up and it was interesting. A little bit earlier, about an hour ago, when I was really going through this, it was looking a lot worse. It was down here, right? It was just kind of dropping off. And I just want to talk about, what do we expect? Because I think we have very short-term memories, right? And it feels like, hey, what's happening today or yesterday is what's kind of driving everything. Well, let's look at this. So the market would run up and pull back for about a week, run up for a couple of weeks, pull back for about a week, run up for a month, pull back, this is 2 days, right? But then runs up for about 2 weeks, pulls back for a week, runs up for, 3 weeks or so, a month, then pulls back for a couple of days. Now, sometimes you get a really big drop like that, but what has it done now? Well, it's run up and it's pulled back for, a week or so. So what does that mean? Where does that leave us? How do we interpret that? Well, let me draw some Fibonacci. Sometimes those Fibonacci's can help us identify, possible areas of support and resistance. And generally speaking, when you're talking about a run up and they say, okay, it needs to retrace and kind of gather its strength again and then run again. Well, usually we're looking at something like maybe a third to half, even 2/3 retracement. It's not like, it runs up and it has a day like this right here. We're just kind of like, yeah, is it a down day? Sure. Is that a retracement? Would you say it gathered is, energy again to run again? No, that was just kind of a blip, right? And so it actually needs to pull back. And so that's the question of how far back does it need to pull? Well, it's up there, but some people say, a third to 2/3, somewhere in there. So let's grab these Fibonacci's. We can come down here on the lower right-hand side, click on that. It's this one right here with the percentage in there. And we're going to take it from this low, this last low, and take it to that high. Basically, I'm going to take it on the run that it's made, from this spot to this spot, and just say, okay, well, from this run that it's had, how far back should it pull? That's the question, right? How far back should that pull? Well, this is our 38%, this is the 50%, and this is the 62%. And I'm just kind of rounding these out. So I'm not always saying 61.8 every time or 38.2 every time. I'm just going to say 38, 50, and 62. But where is it? Well, it was actually looking like it's breaking the 62, which is still a support level, but it was just about a half hour ago is sitting on the 50%. So it's basically, a typical 50% retracement, and then it could possibly rally. Now, has that been decided? No, we don't know that yet, right? But, we got to keep in mind, this retracement that we've seen so far is a typical run up and a pullback. It's just, when you're going through the rapids on the pullback, sometimes it feels like a lot choppier ride than, just kind of the smooth sailing that we'd like to see, right? So keep that in mind. Now, here's something to keep in mind. If it does retrace and bounce, what are some possibilities of it, where it could go? And that's always difficult when you have like all-time new highs. Where could it go from there? Well, it depends on, if we look at these retracement levels, I threw in some projections, and I'm not going to do this today, but another class, join me for another class. I'll cover how to throw on these projections with the Fibonacci. But basically, if it bounces off the 38, then, or basically let's say this, if it bounces off the highest of the three levels, well then, this would be, from technical analysis, the same run as the pull, right? I mean, that would be the idea on a flag. It runs up, pulls back, it bounces, and it runs the distance of the pull. Well, that would be that distance. If it bounces off the 50, it'd go from middle to middle. And if it bounces off the 62, it'd go low to low, or basically, that one. And so that's kind of the general idea. Now, we'll see, it has not bounced. I just want to be clear, it has not bounced. But we're just saying if it does, that's where technical analysis could potentially show as a target area. Up above the 7,000 is a potential. But again, we'll have to see how this plays out. Now, that's just looking at the NASDAQ, or I'm sorry, NASDAQ, SPX. Let's get ahead of myself. Let's go over to some of the other indices. Looking at the Dow, what we're going to see is a very similar situation, right? I mean, a lot of the same stocks are in there, and so it's not surprising to see, same thing. Now, the question I get often is like, do I draw it to the wicks or do I draw it to the bodies? And I just draw it where it makes the most sense, where like, if the bodies are all over and the wicks are in the same spot, I'll draw the wicks. Kind of as a default, I like to draw the bodies, but these wicks are up here about the same spot. And so if we look at this, where are we here? Well, this is only a 38% retracement of that overall run. So we haven't seen, a huge move to the downside yet, just pulling back a bit. And I want to look at one more. Like I said, I don't want to spend all day here, but I just want to look at a couple. Whoops. Looking at the NDX, and very similar. Look at this. I had these. Let's delete these. Let's remove these and look at it right here. I like to get it where we can see a little bit more of the run because it's too squished otherwise. There we go. And we run from here to here. Where are we on the NDX? And NASDAQ's about the same as the S&P 500, right? So RANAP having a couple-day pullback, looking to see where this bounces. Now, let's also take a look at one more item. So we have this overall projection of, okay, we're bullish with a pullback, right? That's the overall what we're seeing technically speaking. So we'll keep that in mind as we look at our positions. But let's also look at the VIX, because I think this is an important thing too. And this was up higher. This morning, it was right up against the purple line. It has since pulled back from that purple line, so it's not hugging that high point. And so this also goes to really emphasize, be careful about making real quick decisions midday. Sometimes where something ends isn't where it was earlier, and it can really change, how, did it break support? Did it not break support or resistance? Those things can really change. But it was up quite a bit higher. And when that spikes, the question would be, how would that impact some of our positions, some of our short verticals and whatnot? And the question, or the answer really is, it kind of depends. It really kind of depends. Just because the market volatility rises doesn't mean that each individual, option position will rise. The volatility doesn't necessarily have to rise there. And on top of that, not all expiration cycles have the same sensitivity to volatility. Now, we've talked about this before, right? There's basically price, time, and volatility, three things that really impact the price of an option. And as we're looking to be these sellers, looking to do short verticals, we're looking to sell, and we're looking for all three of those. Well, we're looking for price to go in our favor, but we're looking for time and volatility to diminish, right? To shrink and let the value of that option diminish so that we can get out of it at a lower price, or just let it expire. Well, so that volatility becomes kind of an issue. And so what I want to do is, let me take you out to let's do CRWD. I want to bring this up. So I'm just bringing this up as an example of something to look at. I put 4 strikes in here, and what I want to do is kind of look at each of the, just kind of, let's just take this first on the call side. We'll take this first out of the money strike. All right, this is a 532.50. And if we look at the, where is it? Let's hold on. If we look at the Delta Gamma Theta Vega, actually, I want to do something else before I get to the Vega. I want to do something else. Hang tight. Let me erase this. We're going to go somewhere else with this. What I'm going to do is I'm going to come up here. I'm going to switch this to Theo Price Mark. Okay. And what I want to do is look at, okay, we got this, the mark is kind of the midpoint between the bid and the ask. And so we got 522. And then down here we have 1822. Why? Because this one has a lot more time built in, right? We're 1 day till expiration on the November 7th, on November 15th. There's more time. If we jump out to like a January 26th, this is at $39, just a lot more time built in there. So let's do this. Let's go ahead and click on the Theo Price right here. And I'm going to just bump this up. I'm going to bump this up and just say, okay, what if volatility comes into all these option, expiration cycles, right? Let's just take this up. Let's see, we got 50 down to 41 or something. So let's bump this about 7 points. So we're going to go up seven points here. And what I want you to do is look at how that changed the options value. So like on this one that expires in 1 day, it went from 522 to 603 with that increase in volatility. So we can see that volatility did have an impact on that option, right? And what is that? About 80 cents, 560 to 640 is about 80 cents, right? But looking at the same strike a little more in the future, and so let's see, maybe I got to write this down. So we had what, 80 cents there. So we're going to write down 0.8. Wow, that's a terrible 80 cents, but we'll have to live with it. Okay, next one, 1830 to 2130. Well, that's what? That's $3 on that one. And then let's go out here. So we can't quite get the same one. We'll have to do the 540. So even a little further out of the money. But this one's going to go from 39.82 to 46.36. So what are we looking at there? About we'll say about 650, right? Just roughly speaking. About $6.50. So now we're talking about the same 7-point increase in volatility, right? But the November 7s, it only increased those options by 80 cents. The November 21s by $3, and the January 26 by $6.50. A huge difference in the impact that that change in volatility had on each of those different expiration cycles, right? Why is that the case? Why is it different? Anyone know? Go ahead and type in those answers as I go ahead and clear the screen. And we're going to look at this. So make sure you got everything. Hey, Will, how you doing? Wiley, yeah, welcome everyone. Good to have you. So it takes a minute for you to populate, but what's going to happen is, let's go back now and change this to Delta Gamma Vega Theta Vega. And what we're going to see is, so time is there, but really what's happening, look at, thank you, yes, theta, here we go, it's the theta, look at the theta. So when we saw that increase in volatility, it's impacting it differently because there's a Vega increase, right, a Vega change. And so when we're looking at that strike, here we had, this is 12 cents, so this is going to be a 12-cent change for every 1 point change in volatility, and we did it, what, 7 points, right? So what is that, about 90 cents, that was about the move there. But here, if you look at this one, we looked at this strike price. This is 43 cents. And so now you're looking at what's 4 times 7, like what, $2.80. And I'm just kind of rounding this out, but that would be a $2.80. This is about roughly 90 cents here. And this one down here is 93 cents. And so we're looking at roughly, what is that? We'll say 630, right? And so the Vega changes depending on, what the expiration cycle is. And the further we go out, the higher the Vega is. So actually, options with more time to expiration actually have a higher Vega and therefore are impacted more by changes in volatility than something that's closer to expiration. And so it's a really weird thing that there's kind of two items that impact implied volatility. So as you get this is like days till expiration. So if this is 0 days to expiration, I got to put it down here, 0 days to expiration, and this is 100 days to expiration, right? Then it's going to impact it a lot more out there than as you get to expiration. It's not going to impact it as much. The other thing that happens is depending on where the strike price is. And so it's the at the money is impacted more so than either out of the money or in the money. And so I'm going a little bit deep here, and hopefully it's not too deep, but all I want to emphasize is basically two things. One is the at the money is the one that's impacted the most of that option chain. And then of all the options, the further out you go in time, then you have a higher Vega, and that impacts it more. So when we talk about impact of implied volatility, it may or may not have an impact on the position, just depending on, is that position far out of the money, or is it far in the money, or, how much time is left till expiration. So those will all play a role in it. All right, we doing okay? We doing okay with this? And again, I went deep, but hopefully I want you to understand the key concept about closer to expiration is less impactful, and well, maybe you should say more time is more impactful, and closer to at the money is more impactful. All right. Good. So anyhow, this Vega will play a role in there, but let's look at those positions. Let's go out and take a look at how our positions are doing. And some of them had a little bit of a spike, and maybe it kept those premiums up, so it's maybe not time to get out, but let's take a look at them. So let's go over to the charts. And we have 4 positions that I've placed in this class over the last couple of weeks. So taking a look at them, and let's see, we start off with Adobe, ADBE. You guys remember this one? Okay. And I want to emphasize this. And so we placed this position on 10/3. So this is like a week before Halloween, right? And a couple days later, so about 5 days later, the following Monday after we did it on Wednesday. The following Monday, we were down $100 in that position. It was not, doing what we wanted to. Here's where we got in. I know that's really small. Let's kind of zoom in on this. We're going to lose this, but that's okay. That's okay. So we're going to zoom in on this so we can see what's going on. Okay. So what we did is we hopped in on this day, and we expect it to kind of stay below this resistance level. And so we put a position right in there, a 360, 365, saying, okay, well, we got a little bit aggressive, maybe right here, saying, let's be below this spot at expiration, right? Now, this one has worked favorably, technically speaking. It has dropped down. I want to throw on some applied volatility on this. We can go up to our beaker, come over to where we type it in, do IMP, and click in implied volatility, and then we'll add that to our graph. And what we'll see, this has been kind of interesting how as the stock has been channeling, it's actually been climbing a little bit. And so that, is saying for this stock, the implied volatility has been climbing. So it has probably had an impact where it's kind of elevated or kind of helped hold some of those option values up there, where normally speaking, if that had dropped, we would probably see them even be smaller as time has gone by. But let's see where we're at. And so we sold it for $1.65. And if we're looking to get most of the money out of there, like 80%, we'll times it by 0.2 to get 80%, and that's going to say, well, we should be around 33 cents or so to say we got a vast majority of out of there. So let's go over to the trade tab. If we look at let's go to the monitor tab rather. And we're going to go over to our positions, and here's Adobe right here. Up $52 on the day, 270 overall. I'm going to right click and do a create closing order, and oh, look at that, we're at 30 cents. So we're at 80%. We've taken, got 80% of the gain. Now, should we take this off or shouldn't we? And so this is always the big question. And so there's not a right or wrong answer, it's just different approaches, right? What can go right or wrong? So what can go right or wrong is, one, we could leave it and then just anticipate that this is going to, stay below this level at expiration, and then both contracts will expire worthless, and then we won't have to, take on that additional expense of placing the order, right? That could be a case. Now, what could happen in between then? Well, something, we do have till the 21st of November. And so, we're still, 15 days away, 2 weeks away, 3 weeks away, two and then slow or two. And, it's possible to rally back up, right? So that could happen, right? Or it could continue on down and we keep all the money. So, there's not a right or wrong, but, typically speaking, we've made $1.35 basically out of that $1.65. We got most of it. And so, we're risking a good chunk of it for just a little bit left. And so that's where, people who have traded these a while have seen that, where they think, oh, I could, walk away with most of the money right now, or, wait. And if they wait, then it goes away. They're like, why didn't I take it, right? And then again, there's not a right or wrong. It's just, sometimes when there's more to lose and less to gain and you're almost there, just close it out. So that's what we're going to do. Okay. So we're going to go ahead and close this position, take our profits and walk away. So I'm just going to go to, not add a position. What am I thinking here? Create closing order, buy that back. And we can even leave that as a limit. It's at 30 cents. And paper money will often just, send it. In real life, it doesn't tend to work quite that way. But we're going to buy that back. Do have some commissions and stuff in there, send that off. And we'll see if that gets filled. We'll see. But yep, taking the profit off the table on that one. So Adobe's been friendly to us. That's been good. Okay, let's look at another one. LCRX. How's that one playing out? Well, maybe if I type it in correctly, LRCX. How about that? Try that. There we go. All right. Now, if you recall on this one, bring this down, move that up. There we go. So if you're calling this one, we entered into a bull, long put spread, or not a long, short put spread, a bull put spread, looking for this to climb higher, right? As it kind of broke out of the symmetrical triangle. I don't know if you guys remember that. We talked about the symmetrical triangle that is wrapping up and is breaking above. And so we said, okay, with this, maybe it'll rally. And so we sold, I don't remember exactly what strike, but it was around here, like the 145 or something. And again, looking for that to run up. We got $1.15 credit. Let's just check that. $1.15 times point, oops, maybe probably got to get the whole thing there. $1.15 times 0.2. Don't be greedy, Gus. That's what Barb says. Okay. It's 23 cents. That's what we'd be looking for to get our 80%. So that kind of gives us a target of where we're getting, kind of most of it, right? Again, some people set a target at, 25%. Some do, like getting 80% and getting out. I said that all wrong. Let me say it again. Some people set a target of, I want to collect 80%. Some say 75%. Some are like 85%. Where you set it is up to you. But I'm just saying, the concept is, get an idea of where you got most of it. And if you got most of it and there's still quite a while to expiration, we may look to take it off. Okay. All right, let's go look at it. LRCX. Well, okay. 480, they made $12 a day. Let's see what we have here. Create closing order. We can buy it back for 25 cents. Okay. Here's the question. It's not at 80%. Darn close. It's darn close, right? So there's a couple things we could do. We could send it off as is and just take, 78% or whatever that is, which is still, pretty good. Or, we could even put in a limit, and let's do that actually. Let's do a limit, say, you know what, we're getting really close. So let's put this limit in, say, get me, wrong way. Get me out when it hits 23% or 23 cents, which is basically 80%. We've made 80% of the money on that one. And then I'm just going to put this, I'm going to do a good till canceled on this. And we'll see here if that one gets filled or not. That could fill over the next couple hours. And I might even look at that at the end of the day and kind of see where it's at. I'm going to go ahead and confirm. And again, note all the information, no error, concerns to look at there. Like sometimes it'll have that, beware of this or that, but nothing popped up. Okay. Now we got two more to look at. Now these other two, these were kind of different. BA, BA, we had we sold a 212.50, 215 call vertical, so we expected it to drop down. And you know what? We had a good sense on that one, I guess. It has continued to drop so far. I mean, things have worked out in our direction thus far, right? Doesn't mean it's going to finish that way. In fact, you see the MACD starting to roll, maybe getting some energy back. But so far, it's played out. Now, when does this one expire and all that stuff? Let's go over and look at this. So let's go back to the monitor tab. We got BA. So this is November 21. So we still have 2 weeks on this one, right? And what did we say we got on that? Was it 64 cents? I think it was. I think it was 64 cents on that one. So let's take 64 times 0.2. And that one will say about 13 cents, right? 13 cents is where we have most of our money. Let's see what we can get out of that one for. 22. Okay, so this is an interesting thing. So 22 cents. Not quite there, right? It's not quite there. Either the stock hasn't dropped far enough or not enough time has expired for us to collect, a good chunk. Now, why don't we just take it off now is the question that comes up at times. Because hey, you have made some money, but you also have to be careful. You have to be careful about just always taking little profits here and there just because maybe we say, oh, it's starting to roll back up and we're going to lose what we have. And so if we do that, we're always looking to take off that profit anytime we have a little bit. Well, then we have these little teeny winners, and then one loser wipes out all those winners. And so we kind of have to weigh this back and forth and just say, okay, you know what? There's so many things going on here, but got to be careful about saying, let's just jump out just because, we might get a little bit of more bullishness. I mean, overall, this could still run up. Remember, this could still rally back up and be below this level. We still make max gain. So nothing's wrong with the trade. We just need more time on this. And then one other I want to hit real quick is going to be our last one. So we're going to let that one ride, by the way. We're going to let that one sit there. Is Meta. And Meta, now, if you remember on Meta, it had a gap down. I mentioned this wasn't the most ideal time to enter. I said it'd be nice to get it closer to support. And look what's happened. It's fallen down to support. So it's at support where we basically entered into a bullish trade here where we sold the 635, bought the 620. And it's losing money, right? We're down $400. I mean, 152 on the day. So what do we do with this one? And this is a good discussion about, okay, how do you manage a trade? And really, it's just like, well, you have to ask, the question is, okay, do we still have time for it to come back? And is there anything wrong with it? I guess we should ask, is there anything wrong first? And then do we have time for it to come back? Well, it's at support. It has not broken through support. It's sitting there. Could it potentially bounce and head back up? Yeah, it could. Is there time for it to rally back up? Yeah, it could. And so because of those two, because we're seeing this drop down, decreasing volume as it's coming down, which would indicate that investors playing this are getting less and less interested in the bearish action. We have the MACD starting to roll over, which would indicate, again, the waning of the bearish momentum, plus it's right back at that level of support. And so this possibly is not the right time to say, okay, time to jump ship, because again, nothing necessarily wrong. It's uncomfortable. Let's agree to that. It's uncomfortable. We would have loved for the stock to have just climbed since the moment we entered, but that's not how life is a lot of times, right? Doesn't always work that way. And so, we asked the question, is it wrong? No, it's not wrong. Do we have time? Yes, we have time. So we're going to let that one ride. Okay. So there's a quick review of the stocks we have out there. Now, a lot of this comes down. Yeah, Zach, they're saying, hey, yeah, let's let it be. Okay. So we're going to let those be. And so, a lot of times comes down to how's the market doing, what's going on in the world, right? And we just got to check those positions and see how they're being impacted. I also, when we talked about the overall market, I mentioned, hey, it's potentially coming back. This isn't pulling back quite like I'd like. In fact, let's look at CRWD. Okay. Oh man. So this is going to be interesting here. So if we look at CRWD, we got CrowdStrike here. we talked about, the rally and the pullback, right? This pullback to 38%. It was sitting down here. It actually was down at 50%. And is looking to see, hey, is there potential opportunity here? Now, one thing that's kind of difficult is making a play right now on something that hasn't closed. It might be more, I don't know if it's going to be more beneficial depending on where the price is, but there's more information about where the price closes, because we've all seen it where it's been up here and then at the end of the day it comes crashing down, right? But we're going to assume it's something like this, and at least indicating that we're getting some support around this 523 area. And so with that, if we have this upward trend, possible pullback, at least a little bit of a retracement back to a support level, we have this old resistance here at 518, this kind of all this meshing together to give us some support somewhere in this ballpark, right? So let's pull this over a little bit more. So let's go ahead and look at a bullish trade on this one, shall we? See if we can enter into a bullish play there. Now, it'd be nice to see that MACD rolling back over to indicate, and whatever it might be, maybe you have an RSI, maybe you have stochastics, or whatever kind of indicator you have. We all have different things. I have on a MACD, and for this, we're looking for it to just roll over and be more bullish. But you know what? If I wait a week, I may not get it. And for purposes of this class, let's go ahead and make that play on that. Let's see what opportunities are out there. So let's see. Let's go and look at, let's see. One day is not going to be enough. 21 might be enough. We're not going to go out to January. Let's get a few more strikes in there as well. Just going to throw in a couple more strikes. We wanted to be somewhere above, what was the price? Somewhere in this ballpark, around that 520, 517, somewhere up there. So what do we have here? Wait, did I get those prices right? Boy, that seems like the price moved that much higher. Well, I guess it is all the way back up here. Wow, it's really changed since I looked at 2 hours ago. It's all the way up to 536. It was a lot closer. I got to get more strike prices on there to see what we have here. So let's bump this up a bit. We'll do 14. See, I might have to even punch in some more. Okay, so we're going to go to the put side. We're going to look at what the possibility is. We could use the delta to kind of give us an approximation of, the probability it could expire in or out of the money. And right now, if we're looking at something around the 517.50, we're around that approximately 32% in the money, so we're roughly 68% out of the money. Let's go ahead and start trying to build a trade around that. And a lot of times building a trade is simply just trial and error. Sometimes you're just poking around saying, okay, well, how does this work? How does that work? And I'm just going to right click on that and say, I'm going to sell a vertical. If I do that, it's going to put it down here and I can start constructing it, So now we have a 2.5 wide vertical and we're getting 90 cents for that, Now, wow, these are really widened out. Wait, hold on. I want to look at this. This is way wide, 950 and 1060. That's getting a little bit too wide from where it was earlier. Let me look at sometimes depending on, usually that was the typical monthly, right? Oftentimes the typical monthly is a good one to go with as far as the bid-ask spread tends to be more narrow. And as you go into the weeklies and even go further out, then they tend to widen a bit. It looks like something's happened. These have really risen since I was preparing for the class a little bit ago. Well, let's still I'm gonna come out and look at this 15 days. Okay, we got 15 days here. Just seeing, I'm gonna go, that's $1. What are these at? That's $2. Wow, that's just too wide. Just too wide. And we don't want to be giving away all of our money in just a spread, right? Or making it very, very difficult for us to get out of it. And so, bringing back, where did our order go? Let's recreate this. So, vertical. And again, the reason that popped up is because I was thinking, okay, 90 cents. But if you look at the mid, that's the mid. You go to the natural, and we're not even close, right? There's just really not that much. It's going to be really difficult in live money to get this filled. So I apologize. That one was looking good earlier. The strikes were a lot tighter. And this actually is a good time to kind of bring up the concern that, you can't always get out exactly where you want. Sometimes those option prices will fluctuate. And, when you hear, oh, I can always buy it back. Well, not always. I mean, depending on what's going on, then out there. Maybe one, you can, but you don't want to get out of the prices being offered, or two, you can't get out. Well, that's unfortunate. So let's actually go back to Apple though. So Apple has, we've had this decline in the market, right, in the last week or two that we've been talking about. But what's been interesting about Apple is it really hasn't been impacted by the market. We can do our same fibs on there. It may have pulled back to like they have a 22 somewhere in this ballpark. It's probably possibly holding up there. And it'd be nice to see it pull back just a little bit more. But I'm wondering, what could we get for this? What if we are around that, what was priced at 272 or 270? What if we got a 265? You can give us a little bit of space to the downside just to breathe in case this pulls back. Let's take a look at that. So let's go over to Apple. The Novembers are tight with that 15 days. If it can be worked, if that can be made, then actually it's not bad, right? But that's not always the case. But let's check it. Let's check it. Let's see what we can get out of this. So let's do a sell vertical here. Sell vertical. And this is interesting. We got 260, 260, 250. Let me just check. Yeah, I think we're looking all right. Let's go 265 on that. So a 265, 260 gives us $1.02 credit. Now look, we're much better here with the bid-ask spread. Here's something I want to bring up though that I think is always important to note. Is if we go, we're going to get $1.02 credit on that if we're just at the mid. If I go, so our risk is $5 minus the roughly $1. So our risk is $4 on the trade for $1 profit, right? That's about 25%. What if we do a 265, 260, 250? Well, what does that do? Well, notice that, if we get a little bit better credit on that, because now we're at 58 cents, we're half of the risk, and so it's 250, right, minus the 58. And so 250 minus the 58 is going to give us a risk on that of, $1.92 divided by, 58. If we're at 58, right, is going to be, did I do that right? There, what was it? 58 divided by the 298? 292? 192. That's, gosh, messing that up, aren't I? 58 cents would be our credit, divided by $1.92 would be our risk. There we go. 30%. So 30%. And so it's a little bit better, but the challenge is now we basically have to double our contracts to kind of get the same so it's kind of the same amount, if you will, because now we're only bringing in 58 cents credit versus $1 credit. But if we get two of these, we'll get about $1, 16 credit versus just $1. So there'll be more commissions on this side, but we're getting a little bit bigger credit, relatively speaking. And so let's run with this one. And so if we're risking that $1.92 when we've been doing $1,000 in this class, $1,000 divided by the 192, and again, that's assuming we're getting a 58 cents on that, is going to be 5 contracts. And so we're going to throw on 5 contracts on here. 5 contracts, 58. I wonder if I can even, I like to push that and see if I can get 60. Sometimes those numbers rounded are nice for teaching purposes, only. I'm going to push out to 60, see if we get filled. We may not, but I'm going to see if we can get that. And I'm going to confirm and just check that real quick. Max profit $300, max loss $950. All right, we're going to go ahead and send that off and see what happens with that and see if we get filled or not. And I did push it, but one of the things I was thinking is there's a possibility of this to pull back just a little bit. And if it does, it does come back down, that could get us filled on that trade. Was that our Apple right there? Yeah, it looks like it. Yep, there we go. Okay, so that's in there. Let's make a note of this one. So it's right about here. Got 60 cents on that, right? So this is 11.6. We did a bull. Let's say short. Come on, I can't type right now. Short put spread. And we got what, 60 cents? 0.60 credit on 5 contracts. So I like to put that in there just so we can see, what we've done, right? Where that's at. And I'll go ahead and kind of change the font and everything later. But it's good to see where things are, what will happen since then. Now, I mentioned at the very beginning, I want to leave you with, some homework, some things to look at. And so we've looked over Apple, we placed a trade, we checked out our positions, we've done everything else. The last thing is just to look at a couple stocks. And so, here's Costco. Could this possibly be something that we could look for a trade? Maybe not right now, but maybe in the future. So what are we seeing here? Well, technically speaking, it looks like it has some pretty good support that's been bouncing off here on a horizontal, right? But if we look at the resistance, what's going on with the resistance? Well, the resistance been declining, right? Whoa, don't want to do that, but I do want to do this. There we go. There we go. A declining triangle, right? Now, technically speaking, if this, does break, and it hasn't yet, we've got to make sure it's clear, but, if this does in fact break, it could possibly go this distance. And so this would give us a potential target on that formation of that pattern. And so that could be a possible target if in fact this does break, but it hasn't yet. I want to be very clear. It has not yet, and it can go up. In fact, if you look at my X feed, I talk about one that rallied up and then continued on up, but it is something to keep an eye because this could possibly break through this and drop down. So that could be an opportunity to enter into a bear call spread there, depending on how the strikes and everything are. And if I do see one, I might place that in between now and our next class. All right, what about another one? Lulu. Okay, good old Lululemon. And if we look at this one, what do we see going on here? Well, we see a channel that's been going back and forth. And, we look at the implied volatility, it's actually quite on the high. It's on the high side. And so does that open up some opportunity to possibly, play a bounce going back up? Or overall, it has had bearish pressure. So do we wait for it to rally back up and bounce off resistance potentially and fall back down? All right. So there's different ways it could be looked at, different ways it could potentially be played, but it's something I want to leave with you to look at, to possibly paper trade if something does come up, and we'll follow up on these next week. And then last one, AMZN. And this one is kind of interesting because I don't know how many of you are familiar with this type of a price pattern, but this is what they possibly call an island gap reversal. Now, I got to be clear, it's not a reversal yet. It's just an island gap, right? It had a gap on earnings, it gapped up. And then from there, what it did is it ran up. I got to get rid of some of the stuff down here so we can have, more room for the price action, right? But it gapped up and then it rallied up and came back and kind of retested that gap, that opening gap, or I guess you should say the closing gap. The point where it kind of started again after it jumped up, right? So it ran up and it's holding that spot there. So a couple things can happen here. Sometimes it will gap back down, as we can see it just gap down to this spot, or it could bounce here and hold. And so let's keep an eye on that and say, okay, does it bounce up and go up, or does it fall back down? Right now, it's just sitting at support. Again, it's not right or wrong. It's just sitting there, waiting to give us possibly another day or two to determine what could, what plays could potentially become of this. So, couple things to think about. So we've covered a lot today. Everything that I mentioned we were going to do. We started looking at the market. We talked about the impact of volatility on options, especially considering we're looking at short options. We want that volatility to shrink. Discussing the fact that the further out in time, the more sensitive options are to volatility, and the closer to at the money they are, the more sensitive they are. And so that can impact it. Then we looked at our positions. We closed two of our profitable positions, looked at one that wasn't doing so well and let another one kind of ride. And then lastly, placed a trade on Apple and looked at some that we can follow up on in the future and follow up on next week. So, hey, thank you very much for joining me. I love having you here. It's good to see you week in, week out. I'm glad to be here, teaching these again. It's been so long, and so it's nice to be back in the saddle, as they say. So, hey, thank you very much. You all have a great day, and I'll look forward to catching you next week, all right? Take care.